What does it look like to build an ETF business? And what have you learned about that over the last 18 to 24 months?
No small questions here. Low barriers to entry of launching the product. High barriers to entry of mattering to investors. I'd start by summing it up that way. And our own experience so far is that we've attracted a healthy amount of attention from self-directed investors like yourself that know the rigor that they would put any company through in deciding to make an investment into it, and appreciate, call it the luxury of getting to ride along with an investment team that is doing the work on a few more companies that they would like to do if they had the time to do it. So that's been a cool little corner of the universe that we've resonated with, and that's certainly a lot of the community that we've been able to grow with on Twitter. Now the reverse side of this is in chasing the aspiration of managing a fund that any investor can access. The vast majority of Americans still rely on their financial advisors for investment placement. So if you want to grow a retail investment management company, you have to figure out how to make your fund useful to financial advisors. And their approach is actually often to be skeptical of funds that have performed because they may be fearful of reversion to mean or fearful of luck. And clearly today we speak about our strategy differently than we did a year ago. And some of that has come through the laborious process of meeting with hundreds of financial advisors and hearing about the things that they care about what we're doing, the things that they don't care about what we're doing. Something I'll share as an example is this phrase, active share. Active share is increasingly becoming one of the most important differentiating elements of an actively managed ETF, which is what percent of the stocks that you own differ from some broad market index. So in the S&P 500 case, we're at about 86% and rising. And that means that relative to the companies that we own, even though you may see some of the same companies in the S&P in our portfolio, it usually means that we are holding them in an overweight position relative to how the S&P might be holding it. And that means that we are giving those investors access to either companies that are outside of many of the indices that they already own, or we are overweighting specific positions where we see potential for higher compounding to happen for them. So there's been changes in some of the go-to-market approach of the reasons to participate in a fund like this that matters. And as we get further down the chain, as you continue to build for the financial advisory community, there are tens of thousands of advisors all over the country, call it more than 100,000 financial advisors that are there to potentially connect with in the US. But many of them are on different platforms, and there's really sort of a graduation of stages. And we're small. So as a $10 million fund, there's a specific set of 20,000 advisors, and when we're a $50 million fund, there's another 20 or 30,000 advisors that we can talk to. And as you climb the AUM ranks, you sort of open up these tiers of groups to speak with. But ultimately, you're doing all of this work because this is the way to get those end real life investors to participate in what you're doing. I've enjoyed the challenge, but it is